Welcome to Pennywise Books, where we turn timeless books into rich, engaging conversations that feed your mind. If you've ever wished for full book value with zero reading, you're exactly where you need to be. Settle in. Today's book might just unlock a new way of seeing money. And if you find this useful, insightful, or even just a little inspiring, go ahead and subscribe. It helps more curious minds find us too. Let's dive in.
Welcome back to the Deep Dive. Today, we're embarking on a really fascinating exploration. It's about something that impacts every single one of us, whether we realize it or not, money.
Mm-hmm.
But forget the usual talk of stock charts and, economic forecasts.
Right.
Our mission today is to really immerse ourselves in some illuminating sources that reveal, I think, a profound truth. Doing well with money has significantly less to do with how intelligent you are.
Yeah.
And a whole lot more to do with how you behave.
It's captivating, isn't it? Because, conventional wisdom often frames finance like it's a hard science.
Exactly. Rigid rules, formulas.
Right, all that. Yet, our deep dive today makes a compelling case that it's actually far more like psychology.
Psychology. Interesting.
Yeah, a realm teeming with emotions and nuanced human tendencies, surprising biases even. We'll be pulling insights from real-world stories, historical shifts, some unexpected research, all designed to help you fundamentally rethink your relationship with wealth.
Absolutely. Think of this as your shortcut, maybe, to truly being well-informed about something that touches your life every single day. So let's begin to unpack this and maybe discover how your own unique experiences and, inherent human nature profoundly shapes your financial world.
Let's do it.
So we're starting with a core premise that might genuinely surprise you. Our main source, the psychology of money. It kicks off with this stark, almost unbelievable contrast.
Right.
Imagine a wildly successful tech executive, a genuine genius, right? Designed key Wi-Fi components in his 20s.
Oh.
Yet he was infamous for carrying these thick stacks of cash, flashing it openly, loudly, often while, drunk.
Oh, boy.
He once handed a valet thousands of dollars just to buy $1,000 gold coins.
Get out! Gold coins!
Gold coins. Then proceeded to throw them into the ocean, like skipping rocks.
Just for fun.
Just for fun. Days later, he shattered a lamp in a hotel restaurant they told him was $500.
Oh, okay.
He dramatically pulls a brick of cash from his pocket, throws $5,000 at the manager, and tells him not to insult him again.
That's something else.
And this man, despite all that brilliance, ended up completely broke.
Wow. And when we connect that story to the bigger picture of financial success, it just powerfully shows how sheer intellectual brilliance in one area, it just doesn't guarantee financial wisdom, does it?
Not at all.
His approach to money, it sounded like it was characterized by, a mix of insecurity and just childish impulsiveness.
Childish stupidity, the book calls it. Now, contrast that, right? Contrast that drama with the life of Ronald Reed, an American janitor, gas station attendant from rural Vermont, first in his family to graduate high school, hitchhiked to campus daily.
Humble beginnings.
Very. Bought a modest two-bedroom house for $12,000 at age 38, lived there his entire life.
Okay.
And then at 92, passed away with a net worth over $8 million.
$8 million as a janitor.
$8 million. Left millions to his local hospital and library.
That just begs a fascinating question, doesn't it?
It really does.
How does a janitor with, zero formal financial training outperform someone like Richard Fuscone?
Right, the Harvard guy.
Yeah, Harvard-educated Merrill Lynch executive, retired in his 40s, super successful finance career, only to later declare bankruptcy.
And that house, 18,000 square feet.
Insane. 11 bathrooms, 2 pools, cost over $90,000 a month just to maintain.
Wow.
So when the 2008 crisis hit, his high debt just wiped him out. No income, foreclosure, the whole thing.
So it wasn't about intelligence for Reed, was it? Or education or connections?
No, it was purely about behavior. Ronald Reed was patient. Simple as that.
And Fuscone?
Fuscone, well, it seems like unchecked greed got the better of him. Financial success, it seems, is way less a hard science.
Yeah.
And much more a soft skill, rooted in how we act.
Okay, so that leads us naturally to, where do luck and risk fit into this behavioral puzzle?
Ah, yes. Luck and risk.
Our source argues they're like siblings, profoundly guiding outcomes, totally independent of individual effort.
There really are two sides of the same coin.
Consider Bill Gates. Attended one of the only high schools in the world with a computer back then.
Yeah, that story's amazing.
A teletype Model 30 leased by the Mothers Club for $3,000 in 1968. Most universities didn't even have that.
Incredible luck. Truly one in a million.
Undeniably. But then, his close friend, Kent Evans, shared the same ambition, same business mind.
Oh, I remember this part.
Tragically died in a mountaineering accident before graduating high school.
A one in a million risk.
Exactly.
And what's truly striking there is how the same powerful, improbable force can just work in completely opposite directions. It's incredibly hard to measure, maybe impossible, and even harder to really accept sometimes.
Sure.
But these accidental impacts, totally outside your control, they can be way more consequential than your most thought-out decisions.
So for every Gates,
there might be a Kent Evans.
Yeah.
Just as skilled, just as driven, but landed on the wrong side of that unpredictable roulette wheel of life.
So when you're looking at people's financial success, or even your own,
it's never quite as good or as bad as it looks on the surface. You have to factor that in.
So what's the core takeaway for your own financial journey here? What should you be thinking?
It's really about letting go of those simplistic stories, that failure is always because of bad decisions or success is only because of skill.
Right, it's more complex.
Exactly. It demands we give luck and risk their proper respect. Look, this perspective helps you avoid making snap judgments about why things happen.
Okay.
And it also encourages a more nuanced view of other people. Be careful who you praise and admire, right? And be equally careful who you look down upon. Because not all success is just hard work, and not all poverty is just laziness. It's often messier than that.
That leads really well into this next idea, the concept of enough.
Ah, yes, enough. Such a powerful word in finance.
It truly challenges how society programs us around wealth. John Bogle, the Vanguard founder, he shared this great story.
Oh, no, the Vonnegut one.
Yeah. At a billionaire's party, Kurt Vonnegut leans over to Joseph Heller, Catch-22 author, and says, basically, their host, a hedge fund manager, made more money in one day than Heller earned from Catch-22 over its entire history.
That's staggering.
And Heller's response, just brilliant.
Yeah.
Yes, he says, but I have something he will never have.
Enough.
Enough. Perfect.
Such a profound point.
And think about Rajat Gupta, orphan teenager in Kolkata, rises to CEO of McKinsey, worth $100 million by 2008.
Had everything, seemingly.
Could have done anything.
Yeah.
Yet, he risked it all on insider trading. Ended up in prison, ruined. Wow.
He wanted to be a billionaire. That wasn't enough.
He called that hedge fund manager 16 seconds after a Goldman Sachs board meeting.
Yeah.
Tipped him off about Warren Buffett.
Just made a quick million himself.
Wow, the desperation for more.
And then there's Bernie Madoff, of course. Unimaginable wealth, prestige, power. Threw it all away. Wow.
More. Always more. It raises that critical question for all of us, really.
Which is?
Why do people who already have everything risk it all for still more?
Yeah, well, the truth is, the ceiling of social comparison is so high that virtually no one will ever hit it. It's a game you can't win.
Keeping up with the Joneses, but on a massive scale.
Exactly. This relentless drive for more just pushes people toward regret, often profound regret.
So having enough isn't about settling.
Not at all. It's about protecting yourself, protecting what's invaluable. Your reputation, your freedom, family, friends, happiness.
Things money can't buy back.
Precisely. No potential financial gain can ever justify sacrificing those things, as Buffett said about that firm that failed.
What was that?
To make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. It is just plain foolish.
Plain foolish. So, okay, what does this all mean for building your own wealth, for your financial future?
Well, it points us directly to maybe the simplest yet most profound lesson. Compounding.
Compounding, right. The book uses the Ice Age analogy.
Yeah, it's great. Think about it. A tiny, almost imperceptible change in solar radiation, but sustained over tens of thousands of years.
Leads to the whole Earth covered in miles-thick ice.
Exactly. All because moderately cool summers don't fully melt the previous winter's snow. It just builds on itself year after year after year.
So you don't need this huge force initially.
No, you don't need tremendous force to create tremendous, even mind-boggling results. When something compounds, a small starting base applied consistently
Can lead to extraordinary outcomes, logic-defying almost.
Totally. You start with a thin layer of snow, and geologically speaking, in the blink of an eye, the planet's covered in ice.
So apply that to investing. Warren Buffett comes to mind.
He's the perfect example. Phenomenal investor, no question.
But the real key, the book argues, to his $84.5 billion fortune, it isn't just his skill.
It's his sheer longevity, his time in the game. Get this, $84.2 billion of that wealth was accumulated after his 50th birthday.
After 50, that's incredible.
If he'd started investing in his 30s, like many people do, and retired at 60, his net worth today would be 99.9% less.
99.9% less.
Let that sink in. His skill is investing, yes, but his ultimate secret is time.
Whoa.
Even Jim Simons, Renaissance Technologies, incredible 66% annual returns, 3 times Buffett's.
Yeah.
He's still 75% less rich than Buffett. Why? Simply because he didn't really hit his stride until he was 50. He had less than half as many years to compound.
So for you, the listener, listening right now, this is a really powerful takeaway, isn't it?
Absolutely. Good investing isn't necessarily about hitting home runs all the time, getting the absolute highest returns on one-off hits.
It's
about consistently earning pretty good returns that you can stick with and which can be repeated for the longest period of time.
Consistency in time.
That is when the magic of compounding truly runs wild.
Okay, but getting money is one thing. Keeping it is another.
Yes, the other side of the coin. Equally important, maybe more so?
Jesse Livermore, one of history's greatest stock traders, right? Made the equivalent of $3 billion in the 1929 crash, betting against the market.
Legendary move.
Seemed like his legacy was set, yet just 4 years later, broke. Made increasingly reckless bets, tragically took his own life.
That's a cautionary tale.
And similarly, Abraham Germansky, multi-millionaire real estate developer, ruined by the same crash. Last seen tearing ticker tape into bits on Wall Street, likely lost his life too.
So both were brilliant at getting wealthy.
Exceptionally skilled.
But equally and devastatingly bad at staying wealthy.
So what does staying wealthy require? It's the opposite of risk-taking.
Pretty much. It demands humility. It demands a healthy fear, actually, that what you've built can be taken away just as easily.
Okay.
It demands frugality, unwavering frugality, and a crucial acceptance that some of your success is down to luck. You can't count on past wins repeating indefinitely.
Like that Sequoia Capital guy, Michael Moritz.
Exactly. The billionaire head of Sequoia attributes their 4 decades of success to being always afraid of going out of business.
Always afraid. That's the survival mindset.
That is a survival mindset.
So what's particularly insightful here for your financial planning, for the listener?
It's prioritizing being financially unbreakable. That's the goal.
Unbreakable. How?
Cultivating a robust margin of safety. Think about card counters in Vegas.
Yeah.
They need enough cash set aside to withstand the swings of bad luck, right? You're never so certain you're right that you bet every single chip you have.
That makes sense. You need reserves.
Need reserves.
Right.
Buffett famously kept a year's payroll in cash at Berkshire, even in good times, just to ensure survival.
He told shareholders something about sleep.
Yeah, in 2008, he said, "When forced to choose, I will not trade even a night's sleep for the chance of extra profits."
Wow. Powerful.
This room for error, it isn't about being overly conservative. It's fundamentally about endurance.
Staying in the game.
Exactly. It's what allows you to stick around long enough for compounding to work wonders. And importantly, it lets you exploit incredible opportunities when everyone else is getting wiped out.
Right, when there's blood in the streets.
If you have cash, you can act. It also crucially accounts for the emotional toll of market drops.
The difference between theory and reality.
Precisely. That often vast gap between what you can technically endure on a spreadsheet and what's emotionally possible when you see your savings plummet.
So it brings us back to that question.
Are you risking something truly important, like your financial survival, for something comparatively unimportant, like chasing a few extra percentage points of profit?
Food for thought. Okay, moving on. We're not just spreadsheets, are we?
Definitely not. We're complex, emotional beings.
And our source brilliantly suggests that in finance, we shouldn't aim to be coldly rational all the time.
No, the goal should be pretty reasonable.
Pretty reasonable. I like that. The fever analogy helps here.
Yeah, explain that one.
Well, it might be rational for your body to run a fever to fight an infection, right? That's the biological mechanism.
Sure.
But it's certainly not reasonable to just let it rage when you're in agony. You want a pill. You want to stop the pain.
Right. You treat the symptom because the experience is unbearable.
Exactly.
And that sparks a crucial question in finance. Academic finance is always chasing these mathematically optimal strategies. But people, in the messy reality of life, they're seeking strategies that maximize how well they sleep at night.
Sleeping well. That's a different kind of optimization.
Totally. Harry Markowitz, Nobel laureate in economics, right?
Yeah.
Famous for modern portfolio theory.
Yeah.
He famously split his own investments 50-50 between bonds and stocks, not because it was mathematically perfect,
But why then?
explicitly to minimize future regret. Even though it wasn't the textbook optimal approach, he wanted to sleep well.
So what's technically true on paper?
Can often be contextually nonsense in real life. Like that Yale study suggesting young savers use 2.1 leverage.
Oh, leverage, yeah.
And just restart if they get wiped out. Rational on paper, maybe, over infinite timelines.
In reality.
Absurdly unreasonable. No normal person could emotionally handle watching 100% of their retirement savings vanish and just shrug and start over.
Okay, so it begs the question for your own portfolio, right? For the listener.
Yeah.
If a small, maybe irrational quirk, like favoring your home country stocks a bit or doing tiny amounts of day trading just to scratch an itch, if that helps you stay committed to your bigger, sensible, diversified plan through the tough times.
Then maybe that commitment itself is the most rational choice you can make.
Because sticking with the plan is key.
Absolutely. The ultimate goal is maximizing your commitment to a sound strategy, because that commitment delivers quantifiable advantages over the long haul. Staying invested matters more than perfect timing.
Let's shift focus a bit now. History. Stanford professor Scott Sagan said, "Things that have never happened before happen all the time."
Love that quote. It's so true in finance.
History, while valuable, it's fundamentally not a map of the future. Why not?
Because finance, unlike physics, isn't governed by immutable laws. It's guided by people.
And people are.
Wildly unpredictable, full of behaviors and emotions. Richard Feynman, the physicist, joked, "Imagine how much harder physics would be if electrons had feelings."
Huh. Good one.
Well, investors definitely have feelings, lots of them.
So there are dangers in relying too much on history then.
Two big ones, according to the source. First, you'll inevitably miss the outliers.
The black swans.
Exactly. Those rare, unpredictable moments, the Great Depression, World War II, the dot-com bust, 9/11, COVID. Or even the positive outliers, like the birth of a Bill Gates.
Right. They shape the world more than the small stuff.
Far more profoundly than incremental changes. Second, history often fails to account for structural shifts.
Things that fundamentally change the game.
Precisely, like the invention of the 401k or the rise of venture capital index funds. These alter how money works. Benjamin Graham, the father of value investing, he constantly updated his formulas 5 times between 1934 and 1972. He knew what worked yesterday might not work today. The landscape changes.
And here's another surprising factor, maybe overlooked. You will change.
Ah, yes. The end of history illusion.
We know we've changed in the past, right? Our tastes, our beliefs.
Oh, yeah, definitely.
But we dramatically underestimate how much our personalities, our desires, our goals will shift in the future.
It's so true. We think our current self is the finished product.
The story of the doctor who ended up hating his dream career because his priorities shifted. That really hits home. The stress, the hours, they wore him down.
Yeah, a poignant example. So this raises a profoundly important question for planning.
How do you plan for a future where your own desires are basically uncertain?
Well, it means consciously avoiding the extreme ends of financial planning.
Like what?
Like assuming you'll be perfectly happy living on a shoestring budget forever, or that you'll happily work 80-hour weeks until you're 70.
Right, leave some flexibility.
Exactly. And it also means cultivating the willingness to abandon sunk costs.
Right.
Not letting past decisions, especially big ones made by a different you years ago, rigidly dictate your current path. Don't throw good money after bad, or good time after bad, just because you started something.
Embracing that reality up front minimizes future regret.
It really does. Adaptability is key.
Okay, finally in this section, let's talk about the price of success. Nothing's free, right?
Nothing's free, especially not investment returns.
The S&P 500, for example, returned, 11% annually for decades. Pretty amazing.
Phenomenal long term.
But the true price of that return wasn't just the money invested. It was.
It was the volatility, the fear, the doubt, the uncertainty, and the regret that inevitably came with it. Market crashes, corrections. That's the cost of admission.
And many investors try to get their return without paying that emotional price.
Oh, yeah. They try to avoid the volatility by trading in and out, trying to time the market.
Which usually backfires.
Almost always. The profound irony is, by desperately trying to avoid paying the inherent price, investors often end up paying double. They miss the upside, incur transaction costs, make emotional mistakes.
Like Jack Welch's GE, maybe?
Yeah,
Massaging numbers to hit forecasts?
exactly. Pulling gains from the future created huge problems down the line. They were trying to avoid the short-term pain of missing a target, but paid a much bigger price later.
So the key is to reframe it.
Yes. View market volatility not as a fine, not as a punishment for doing something wrong,
But
as a fee, like the price of admission to Disneyland.
okay, I like that.
It's a necessary cost for potentially experiencing something extraordinary long-term growth. Few investors can genuinely say, oh, I'm fine losing 20%, right?
No way.
But if you frame it as, this is the fee I pay for the chance of excellent long-term returns, it becomes much more palatable. You expect it, you budget for it emotionally.
Okay, this next concept, it's really eye-opening. Why do so many things seem to go wrong in business and investing?
Yeah, this is fascinating. It's all about long tails.
Long tails.
Basically, the vast majority of efforts or investments fail or do poorly, but a tiny, tiny minority of successes account for the overwhelming majority of the positive outcomes.
Okay, give me an example.
Think about Walt Disney. He produced hundreds of cartoons, many beloved, but actually unprofitable.
Really?
Yeah. And then Snow White premiered. It transformed the studio overnight, earned an order of magnitude more money than anything before it. That one huge hit paid for all the misses and then some.
Wow. One big win.
And this pattern is strikingly clear in venture capital.
Right, VC funding.
An estimated 65% of VC investments actually lose money.
65%, that's high.
It is. But a tiny fraction, maybe 0.5%, like 100 companies out of 21,000 they looked at generate 50x returns or more.
So those few massive winners.
They single-handedly drive the entire industry's impressive returns. Without those few tail events, VC returns would be mediocre.
And this applies even in the broad stock market.
Absolutely. Look at the Russell 3000 index since 1980. 40% of those companies basically lost most of their value over time, wiped out shareholders.
40%.
But a mere 7% of the companies accounted for nearly all the overall market gains.
7% drive everything.
Pretty much. So the most impressive people, the most successful ventures, they're often packed with what seem like horrendous ideas or failures along the way.
Like Jeff Bezos and the Fire Phone.
Perfect example. He famously said, if you think that's a big failure, we're working on much bigger failures right now. Because he knew you only need a few Amazon Web Services or Prime-level successes to offset everything else.
So the implication here is pretty radical then.
It is. You can actually be wrong half the time and still make a fortune.
Wrong half the time.
As Peter Lynch, the legendary investor, said, if you're terrific in this business, you're right 6 times out of 10. That's considered terrific.
So the real genius isn't always about being right more often.
Not necessarily. It's often about the magnitude of your wins versus your losses. And crucially, it's the man or woman who can do the average thing when all those around them are going crazy.
Sticking to the plan during chaos.
That steadfast ability to stick to a sound plan during those few terrifying moments of market panic. Because those moments, paradoxically, often account for most of a lifetime's returns if you handle them right or wrong.
Okay, and this leads us to another really interesting human tendency. Why does pessimism so often sound smarter?
Doesn't it, though? It sounds more intellectual, more profound somehow.
Yeah. The historian Deirdre McCloskey observed, people like to hear that the world is going to hell.
It's true. Forecasts of outrageous optimism are rarely taken as seriously as the prophets of doom.
Why is that, do you think? Especially with money.
Well, partly because money issues are so universal, right? They affect everyone personally, so bad news feels more relevant, more threatening.
Okay.
Also, pessimists often just extrapolate current negative trends indefinitely, without fully accounting for how markets and human ingenuity adapt.
Like the 1970s oil crisis.
Sure.
Everyone thought we were doomed.
Exactly. And that crisis directly sparked the innovation in fracking that quadrupled U.S. oil production decades later. Markets adapt. People solve problems.
That's a good point.
Plus, there's an asymmetry in how we perceive change. Progress tends to happen too slowly to really notice day to day.
Right, it's incremental.
But setbacks, they happen very quickly and grab all the attention. Think Wright brothers, their invention was ignored for years. But a single plane crash. Global headlines instantly.
That's true. The negative is much louder.
Much louder.
The book uses this analogy of an alien observing New York City between 2007 and 2009.
Yeah, the alien perspective.
They'd see no tangible difference, right? Same lights, same buildings, same people, technology even improves slightly.
It's the same.
Yet the economy suffered its worst blow in 80 years during that exact period. The only thing that truly changed
Was the story. The narrative we told ourselves about the economy. Fear took over. Confidence collapsed.
That's powerful. It just shows why people, especially when stakes are high and information is limited,
They were willing to believe anything. They become vulnerable to financial quackery, to Ponzi schemes like Madoff's.
ignoring obvious red flags.
Because they so desperately want that huge, easy outcome to be true, the story is more appealing than the boring reality.
Which brings us to a really crucial final question in this part.
Okay.
When you're making your financial decisions, are you maybe being influenced by people playing a fundamentally different game than you are?
That's a critical point. Explain that.
Well, think about bubbles. Short-term traders driving up prices. Yeah. Their game is momentum, getting in and out quickly. That's rational for them.
Right, their time horizon is minutes, days, maybe weeks.
But a long-term investor, someone saving for retirement decades away, can get totally swayed by that short-term frenzy.
Yeah, they get sucked into playing the trader's game, often at the worst possible time. The dot-com bubble, the housing bubble, classic examples.
So this observation powerfully underscores that there really is no single universal right answer in finance, is there?
Absolutely not. There's only what works for you, for your time frame, your risk tolerance, your specific goals. You have to know what game you're playing.
So after all this, this whole deep dive, what does it all mean for your financial journey, for the listener?
It really culminates in a few key, I think, very actionable takeaways.
Okay, let's hear them.
First, it's about cultivating humility when things are going well.
Right, acknowledge luck.
And finding forgiveness for yourself when they go wrong, because the reality is it's never quite as good or quite as bad as it looks from the outside.
Okay, humility and forgiveness. What else?
It's about accepting that many things in your financial life will probably go wrong. Investments will fail, plans will change.
That sounds pessimistic.
Not really, because the flip side is knowing that a few big successes, if you can just stay the course, can truly outweigh all those smaller failures. Remember the long tails?
Ah, right, the Snow White effect.
Exactly.
What's most important, would you say?
I think most importantly, it's about strategically using your money to gain control over your time.
Control over time.
Because the ability to do what you want, when you want, with who you want, for as long as you want, that is arguably the highest dividend money truly pays. It's freedom.
That's a powerful way to think about it.
It also encourages us, maybe counterintuitively, to be nicer and less flashy.
How so?
Because genuine respect and admiration, the things we often crave, they flow from kindness and humility, not from the horsepower of your car or the square footage of your house. Nobody is as impressed with your stuff as you are.
Sure enough.
And maybe most fundamentally, simply save. Just save money.
Not for anything specific necessarily.
Not just for specific goals like a car or retirement, but save as a powerful general hedge against life's inevitable surprises. Unknown unknowns.
Savings is a buffer.
Every bit of savings is like reclaiming a piece of your future freedom that would otherwise be dictated by circumstances or your boss or emergencies. You're giving that freedom back to yourself.
Define the true cost of success, the volatility, the doubt, and be ready to pay it. See it as a fee, not a fine.
Exactly. And worship room for error, that margin of safety, because that financial cushion ensures you can endure.
And endurance is what makes compounding work its magic over time.
Precisely. You have to survive to succeed long term.
Also, actively avoid those financial decisions at the extreme ends of this spectrum. Why?
Because you have to recognize that your goals, your desires, you will change over time. Don't lock yourself into something decided by a past version of yourself. Allow for evolution.
And finally, define the game you're playing.
Yes. Know your own goals, your own timeline, your own risk tolerance. And refuse to be swayed or distracted by others who are playing a fundamentally different game with different rules.
It's interesting how the author shares his own approach.
Yeah, his confessions. Prioritizing independence by owning his home outright, even if it's not optimal leverage-wise.
Right, and holding a substantial cash buffer, more than calculations might suggest.
And consistently investing in simple, low-cost index funds. Boring, maybe, but effective for him.
It just beautifully illustrates that authentic financial decisions aren't made purely on spreadsheets, are they?
Not at all. They're made at the dinner table. They're shaped deeply by personal values, by history, by unique experiences, and fundamentally by that basic human desire to sleep well at night.
There really is no single universal financial truth.
Only what genuinely works for you. Your mileage will vary.
And that truly, I think, is the profound beauty of this deep dive into the psychology of money. It challenges you, the listener, to look beyond just the cold numbers.
And really understand the warm, messy, wonderfully human element that drives it all.
So for you, the learner, perhaps the provocative thought to carry forward from today is this.
Okay.
In a world that's constantly full of surprises, where your own future self might have entirely different desires and priorities than you do today, how will you design a financial life that prioritizes resilience, adaptability, and ultimately ensures you can always define your own personal version of enough?